Thanks for joining us today for our weekly investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. Now, obviously, this is a busy week from a political and also a monetary policy perspective. We're recording this ahead of Tuesday's election, and next week we're going to have more color around the actual results. But this is also a Fed meeting week, and we look for the Fed to cut interest rates a second time here by 25 basis points. Now, cutting the policy rate is supported by inflation that's generally trended in the right direction this year, and also a softening labor market. So let's take a look at the data from last week because we really got updates on both of those things. So starting with inflation, the personal income and outlays report that houses the Fed's favored PCE inflation metric. That came in at 2.1%. So we're really close to their 2% target, and we're below where the Fed originally thought inflation would be to close out 2024. Now, energy prices have helped a lot this year. Year to date, a broad energy commodity index that we track is down 5%. We also got an update on home prices, which did show some moderation to a 4.2% year over year rate, which is in line with pre pandemic trends in house prices. Now, looking at the job market, it was extremely messy last month. ADP payrolls greatly exceeded estimates to the upside, but the official BLS employment situation report showed only a net addition of 12,000 jobs. Now, there were two hurricanes and a strike at Boeing that greatly impacted the data. In fact, manufacturing showed a large detraction of jobs, and that was directly attributable to the Boeing strike. Now, some of that labor market data is likely to normalize here as we get into this month. And also, the unemployment rate was unchanged, and hourly earnings were up a strong 0.4% in October. And those numbers are consistent with a still solid labor market overall. Now, another big data point from last week was the GDP report for Q3. It showed that the economy expanded 2.8%, which is pretty solid growth. Now, sales to domestic purchasers, or better known as consumer spending, was up 3.5%, which is also very solid. If there was a crack in the GDP report at all, I'd want to see residential investment picking up. And last quarter, it actually contracted. We have a housing shortage here in the US, so that is something to watch. But all in all, Q3 was a solid quarter of growth. Now, that solid growth is showing up in the earnings season. So far, there have been 326 S&P 500 companies to report for the third quarter, and that represents 62% of the market cap. Thus far, earnings have grown almost 10% year over year, and sales growth is up almost 6%. So that implies that there's been some profit margin expansion. Now, margins have been improving throughout this year as labor productivity has improved and businesses have maintained some pricing power. Now, other than the presidential election and congressional elections, we've got that Fed meeting this week. And as we said, we expect that they're going to cut interest rates by 25 basis points, following up that 50 basis point cut that they did in September. Now, even though the economy's still been solid, there has been some easing in the labor market. And with inflation going the right way, the Fed wants to try to ease the pressure on interest rate sensitive economic sectors. Now, following this week's Fed meeting, the market's also currently pricing in high odds of a 25 basis point cut in December as well. So that would take rates down by a full percent from the peak rate. Now, that's probably still a little bit restrictive from a policy stance, but certainly less so. Now, there isn't much other than the election and the Fed that is very impactful this week, but those are obviously big events. Market trends have held in all year. Long term, the bull market's been well intact, but sentiment has been quite optimistic, which that makes the market somewhat more vulnerable to near-term weakness. But all in all, the macro environment, earnings growth, and trend data remain constructive for the health of this bull market. So join us next week to hear our take on the possible policy mix stemming from the election and anything else that we might be monitoring. And as always, thanks for joining us and have a great week ahead.